Hello, everybody. Welcome to another edition of the Mosaic podcast. I am Mandisa Zavala, Head of Asset Allocation at Alexforbes, and I'm joined by the beautiful, stunning African queen, Mpomula Piane, who, by the way, I'd forgotten to say her name, and she corrected me. Mpo, here we are, a month later, after we sat on these chairs and this table, just a week into what we expected to be a very short-lived war. And now we are a month in, and we've actually had to become war experts, and we've had to read multiple articles. And you were even telling me you know all the names of the US ships, warships. So here we are. What is going on? Are you okay, firstly?
Well, I am. Thank you for asking. It, has been quite a long month.
Yeah.
I feel like this is the only thing that we've discussed, right?
Yeah.
I mean, yes, we've tried to find the light-hearted side of the situation, but there is a human toll that is currently ongoing. On top of the market losses, obviously, that have ensued, right? But I am okay. It's been a very long month.
Yes.
I can't believe, like it feels like we are 6 months into the year.
Yes.
Like I feel like year-end fatigue is
Yeah,
about to
thank
kick
you.
in anytime soon,
Same.
right?
Yeah.
But yeah, it's been a very long month, and it feels like the only thing we've literally talked about is the Middle East conflict.
Yes.
And just given the questions and uncertainty around what this means, we've literally had to dig deep and learn and find out things that you're
Who
like
knew?
like you're sitting
I
and like
know.
no, but like why do I know the
Yes.
name of the the US warships, like why, but like
Yeah.
that's literally like the type of details
Yes.
essentially, and the
Yeah.
type of information we literally have to dig deep into, because if like and also like people would be sitting and asking like why do you need to know like the name of the warships, but it's about knowing the number of
Yes.
warships that the US has,
Yeah.
that can potentially deploy to the Middle East to try and stabilize the strait.
Yes.
That's why we need to know the type of
Yes,
information.
please.
Yeah. It's not because we want we want to.
It's a hobby.
No, 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 no,
it's
no, no, no,
not.
no, no. Yeah, but essentially, like you're right. Getting back to the discussion, you're right. I think we, early when the war broke out, and when we were having this discussion last month, the market narrative was essentially that this is going to be short-lived, and that
100%.
was premised on the ramifications of a protected war, the ramifications of what that would mean for U.S. midterm elections, right? A protected war would lead to higher oil prices, and it would exacerbate affordability issues, and it would, essentially lead to a referendum come midterm elections, right? And we know that Republicans already have a thin majority, so that's why everybody thought this would be short-lived. But the longer this is ongoing, it's certainly looking like it's going to be a lot more protected than we initially thought. I mean, we also have to admit that the risk is two ways, right? It's a two-sided risk. We could wake up tomorrow, and I think it's important for us to mention that we're actually recording this on the 31st of March. And we could wake up tomorrow with an announcement that a ceasefire has been reached, and there's a resolution to open up the strait.
Day.
It's Liberation Day. Essentially, Liberation Day 2.0.
2.0.
Essentially.
Maybe.
Essentially.
I
Maybe.
don't know.
But on the other hand, when we look at other indicators, such as deployment of Marines, deployment of warships to the Middle East, suggests that we could continue to see an escalation of the conflict, right? So it's looking more like that scenario 3 that we talked about last month, that, this war likely to be a lot more protected, meaning that the global economy may have to contend with higher oil prices
100%.
than we anticipated at the beginning of the year for a much longer period,
Yeah.
right? Now, that, suggests that fuel prices will be higher. It also suggests that consumers and businesses alike actually have to contend with higher input cost,
Yes.
higher consumption cost, and that points to a larger drag to growth essentially. And we're also seeing this differentiation between all importing countries as well as all exporting countries, right?
Yes.
So your all exporting nations are obviously going to be benefiting from higher demand, higher oil prices, and we're also seeing that energy importers are going to experience an even larger drag to growth, right?
Yeah.
Because the import bills essentially have increased enormously. Now, I want us to take it back to what this essentially means relative to our expectations at the beginning of the year, right? I mean, this points to completely different macroeconomic backdrop
Yes.
that we were expecting at the beginning of the year, and that Goldilocks environment that we were expecting has been significantly challenged. We're expecting that growth. We came into the year expecting that growth will continue to hold up, inflation will continue to edge down, and central banks in particular will continue to ease, or at least keep monetary policy accommodative, right? But if we are now talking about higher fuel prices, that is inflationary, and central banks will find it quite difficult to ease policy rates in this environment. Now, we've only talked about, we've mainly just focused on that inflationary impact, but the global economy may also have to contend with continued, physical supply shortages, right? The longer this war continues. But, I just want to get your sense of this change in the macroeconomic environment. What does that essentially mean for risk positioning? Understand that we came into this environment risk on, but, the macroeconomic environment that that was premised on has been challenged. So what's your thinking around risk at the moment?
Yeah, it definitely, it's a challenging one. I think most of us were, guns blazing. We're going to be shooting for all fours essentially, and trying to go for as much as we can and squeeze this lemon out for as long as we can. And the reality is we have been hit with what is defined as the black swan theory, which is this event that came out of nowhere, that by essence the theoretical concept itself says that it's a catastrophic event which no one can predict. And so I don't know if anyone was betting, but if it's a black swan event, you would not have been able to get it right. And so, yes, to your point, there's this event that has now come in, and it has indeed changed their narrative. Of course, if it had just happened, if it was just a 1 week incident, or maybe we can even go to 2 weeks, it would have still been okay. We could have still been, would have left unscathed and would have continued the way that we came in and still been risk on, because fundamentally there was a lot that was riding on, this being an environment of very high positive earnings. And so expectations have to shift. Whether we like it or not. We're already a month in. It's now no longer just a sentiment thing. As you've mentioned, there's production issues. There's actually things that are now going to be baked in the numbers that even if tomorrow we were to get a ceasefire, we still have to contend with those things coming through in the numbers. And I mean, that sort of brings me to the dynamics that we're seeing as well within the markets. Markets are not pricing this as an event that is black swanny. That's not a name. It's not a word, but like, let's just use it, just for now. And I think maybe because a lot of us had come in with a lot of risk, and had come in, being very, very positive, which rightfully so. Everything, we had disinflation. Finally, the OBB was going to come in to the numbers. The US was going to be rallying. We had Europe also still doing their fiscal packages, defense spending. Like, everything was actually, there were just ticks all around.
The stars were lined up.
The stars were aligned, especially for emerging markets, which has been so long. If EMs have not had their time in the sun, and now they were just being given this time in the sun, and they were basking in it. And so you've got this black cloud that's come in, and huge gray cloud that's come in and just disrupted everything. So yes, you have to contend with that. What we are seeing now, though, and again, we have to premise this by saying, it's as at the 31st of March, when we are recording this, that the earnings picture has not taken into account that this is a disruption that has lasted longer than a week and 2 weeks and 3 weeks and 4 weeks, that this is actually a month issue. So no one, at the current moment, consensus earnings are not coming in to sort of show that actually there's almost a higher cost input that you need to take into account for businesses going forward. Maybe it may not necessarily be, you want to predict whether this lasts for the next year, but definitely it's dented things in some instance. And not only from an earnings picture, and that's why we need to watch that very carefully, but also when we look at performance, and how markets have been performing globally, as well as even our own local market. What was interesting for us is when you compare how much you got from the stock market in, let's use an example here. We'll take UK equities. How much did we get from UK equities from the end of last year till the day before the war broke out, which was, we'll call this the 27th of February. You got about 10.37%, let's call it 10% from UK equities, which is a very strong number if you think about it. Again, that shows that, we were in this boom environment. What happened in the following week was that we then ended up losing 6% because of the onset of the war. Then a week later, we were down only 0.9%. In UK equities. Then a week later, we were down about 2.6% in UK equities. Now, for me, that says that is not the types of drops, those are not the types of declines that you'd expect if this is a huge if it's a huge spanner in the works. I will, however, say that, it's very difficult to it was very difficult in the first week to predict that this would be a month or even 3 weeks. I think even 2 weeks we felt was sort of pushing it. So I understand that perhaps markets are trading the information that they are seeing, that they're experiencing at that time. But what that leaves you with, especially as someone who is forward-looking, is saying there's a risk here, because if we're not pricing in the fact that this is no longer a disinflationary environment, that this is no longer an environment where growth is robust, that actually the positioning also needs to change. And that means you could either be too late now, where you've overstayed your welcome at this party, which unfortunately has ended not because of fundamentals, but it's just ended because there's a war somewhere. And so in terms of positioning, we have eased off on some of the equities because we felt that we were light on the defensive side of things, and we've picked up some of our defensives. I think also what benefited and what should benefit and bring comfort to investors is that we had a great year last year, and so a lot of those returns, remember, markets were giving us over 30%. That, just by the example that I've given you, the market in some and not all indices, it's only drawn back what it's given for this year. It hasn't even gone into what it's done last year. So there's still room for maneuvering and being able to take off risk and still being able to position likewise. And I think maybe just to sort of also bring in another point as well, you mentioned how we've got these fuel price increases that are coming in, which are going to make it very, very adverse for the consumer as well as businesses as well to contend with the current environment. There's a very interesting piece that the IMF has done around trying to figure out whether the rise of fuel impacts emerging markets and developed markets the same. And they're trying to look at different, the baskets of inflation within these markets. The output from this study says that actually in total you find that there's more items in emerging market countries that are impacted by fuel costs than they are in developed markets. Essentially, the basis of this is saying an environment of heightened fuel costs impacts EMs more adversely than it does DMs. Of course, we know that there's nuances because you do have your Europe, which is very exposed to this crisis because they have very high gas prices. But when I saw this, it got me thinking around South Africa to say, we were at a point where we didn't even know what to talk about when it came to South Africa. I think there was even a time we were like, guys, it's so boring because the story's so good. There's nothing to talk about. Perhaps maybe we should, kind of talk about that. And I want your view around, in the context of this, is South Africa at risk, and how are the dynamics sort of playing out, and what do you expect to happen over the next month, just given where we are now? Because, we can't predict the next 3 months, but just given where we are now.
Yeah, I mean, yes, I think the IMF paper is right, because what you do tend to see is that emerging markets and South Africa do have higher weighting. So like when we look at the CPI basket, they have a higher weighting of energy, fuel, as well as food, right? So, and that's the problem with fuel cost, is that firstly, the impact is felt immediately by consumers and businesses, right? Because higher oil prices means that fuel costs rise, immediately. South Africa, fuel prices are going up tomorrow. I must say those EVs are looking more attractive now.
Yes.
Right. But let me not digress. So yes, the problem is that fuel cost increase, and the majority of food in South Africa is actually transported by road, which now means that higher fuel prices can feed into higher food cost, given the higher transportation cost that retailers and producers now have to take into account, right? So that's the transmission mechanism that we've also been closely monitoring for South Africa. And as you correctly pointed out, that, the stars were aligned for South Africa. We had a good budget. We were expecting more interest rate cuts. Bond yields were compressing.
That's good.
The party was on.
It was on.
Right? And that party has essentially been disrupted if it hasn't ended for South Africa, right? We think that in this environment, the SARB will find it quite difficult to continue cutting policy rates. Remember that at the beginning of the year, we were expecting, an additional 75 basis points worth of easing in the cycle. And at the recent Monetary Policy Committee meeting as well, I mean, the SARB, essentially in line with what the communication we've seen from global central banks, taking a cautionary stance, given the uncertainty. Everybody's literally trying to wrap their head around, how long this disruption is going to last, which is difficult, right? But a protracted conflict essentially means that the SARB is going to find it challenging to ease policy rates in this environment. Given that inflation will be higher. And remember that last year they announced a 3% inflation target. Now, with the fuel price that we're going to see from the 1st of April, yes, the Minister of Finance has recently announced that there will be some relief, but
a couple of rands.
You said it, not me. A couple of rands, right? Like it. To be honest, it's not going to do much to move the dial. When we do look at the numbers, I mean, like for petrol prices, for instance, we were looking at close to a 6 rand increase in petrol. So the measure that the minister announced essentially means that petrol price now increased by 3 rand. But for diesel, on the other hand, and remember that diesel is actually used in industrial production. It's used in the manufacturing sector. It's used to transport goods, right? And that price increase there it's a lot more steep. close to 10 rand. With the measure that the Minister of Finance announced, you're still looking at a 7 rand increase. So quite steep. And it will be inflationary. It will lead to a larger growth drag. But from an inflation perspective, right? So, at the beginning of the year, we thought inflation would at least average around 3.6%, but we're now looking at an average of around 4.1%, and we're looking at an inflation peak of around 4.6%, if not higher, right? So that's the other thing we also have to caveat is that so far, the oil price also does not seem like it has fully priced in the supply disruption that we have witnessed. And if we do continue to see those physical shortages, oil prices could move significantly higher, right? Which means that the peak in inflation would also be a lot higher. So we think this environment essentially constrains the sub, given that inflation is going to drift further away from the sub 3% target. We think that there could also be a tilt towards tightening as well. But for now, we think that no more cuts on the table, essentially. And we may have to contend with monetary policy tightening the longer this continues.
What a change in the tone.
Yeah. Quite drastic change in the macroeconomic environment, right? I would, be interested. I mean, on the global side, we talked about how the risk positioning has changed. From an SA perspective, I'd be interested to hear your views on, which sectors would do well in this environment.
Oh. It's very hard. It's so hard, I think, because I will start off by saying when we entered this year, we were excited about resources. But also the reason why resources were exciting is because when you looked at earnings, South Africa had quite an interesting tilt towards the strongest places where we were going to get earnings was from resources. And the rest we're going to give you here or there. Yes, double-digit returns, but still, like you were going to get close to 100 or even over 100 on resources. And I think fast forward to where we are right now, obviously some of those have to come down, but what we do take note of is a commodity like gold is likely to still hold up. And I also say this, also taking into account that gold has pulled back quite massively. It was over 5,000. Expectations of it going towards 6,000 were there. And now it's around the 4.5s. And so that is a huge pullback from where it was. Our expectations, we're not bearish on gold because we still think that we saw the trend of gold moving into a strategic holding within portfolios, but also strategic holding as well within sovereigns just in general. So I think that still remains something that we don't see banks outright selling, gold unless, we get into a very dire situation where people, there's certain, I know there was a particular country that was, and also you don't know what is true and not in terms of the news that's published. But apparently there was a debate that was going on around perhaps one of the countries was debating whether they should sell their gold reserves to protect the currency, and it was an emerging market country. And so if it gets to those levels, then you obviously start to see more downside in gold. But I think at the current moment, it still remains a good hedge around inflation, but also just as a hedge, just in terms of what it offers in portfolios. It also makes sense that because it had done so well, the profit taking would happen in a commodity like gold. You're going to take profits there. You're going to take profits from your silvers, which had actually performed really well. And that's the trend that we started to see. Thirdly, also, you do actually tend to see gold sell off under geopolitical tensions at the beginning, and then it starts to resume its protection characteristic. So the most recent performance is not something that's unfounded. Obviously, the magnitude of it has been a lot more adverse because of some of the reasons I mentioned. So I think gold, precious metals, is probably still going to remain a theme going forward, because just because we have these supply side constraints that are happening, and again, it sounds so crude to say this, but businesses still continue and they have to continue to function. Yeah. I just came now from the South African investment conference, and they're talking around investments in technology, data centers that are being built, all of these things. All of that actually needs commodities, and there's precious metals, but there's other commodities as well that South Africa has an abundance of, that the world is still looking for. So, and I think these are the type of sectors that you want to still be exposed to, because they offer that kind of defensiveness in that it actually is not, it's become less cyclical and more of a theme that's going to be a long term. In terms of some sectors that likely do well under a scenario that you pointed out, to say perhaps the SARB even considers things like tightening, banks hold up quite well under those types of scenarios. So we expect that our banks having really strong balance sheets are likely to navigate this environment. Obviously, I think they were looking forward to the current trend of now you have the consumer coming in and debt. They're going to be more confident to take up credit. So they were probably going to benefit from the credit cycle, but also just the way that they are leveraged or endowed makes them actually quite competitive in an environment where interest rates are going up. And of course, we have our rand hedges, which also sit on our JSE, which actually look like they might be a very good place to be. And I think from an equities perspective, those are the kind of sectors you'd want to be looking at. And in addition, perhaps outside of fixed income, you obviously want your SA cash, just because it offers that good hedge and it gives you opportunity when this blows over. And I said when, because it's a when it blows over, you can still have some money to sort of deploy, but also you've got your inflation-linked bonds, because if we're worried about inflation or inflation expectations, those types of things come through quite nicely. Before we wrap up, I'd be interested to know from you the 3 key things that you and your team are looking for and are looking at right now, just for, some of the people that are following you. I know they're followers of Mpho out there, like, just so that you know what she's looking at and you can look at what she's looking at.
Oh, wow. So from a macroeconomic perspective, I think what we are worried about is the type of escalation that we could get, particularly damage to oil infrastructure, critical energy infrastructure, because that would move us from a temporary shock to a more permanent shock, because infrastructure that is damaged takes longer to repair, so which means the global economy now has to contend with a permanent supply disruption rather than a temporary supply disruption. And then obviously oil prices as well, given that those are inflationary and will affect the monetary policy calculus from here on. And lastly as well, what we will be watching is the demand destruction. So we've mainly focused on, the inflationary impact and what central banks are likely to do. But, if this ends up being the severe supply shortage and we need to see demand destruction, which we're already seeing in other economies, right? So, things like working from home, rationing fuel, that could be massively disruptive for GDP growth. That would also change the monetary policy calculus, actually. If we, now talking about a recession because of the demand destruction, central banks then also have to be cutting in that environment, right? So for us, those are the key 3 things that we will be watching. From a market perspective, what's the 3 top things?
The first one would definitely be credit spreads. I think if you start to see those blow out, it means that it's much more expensive for corporates to source funding now, which will slow down the capex cycle. And so that will not be a good thing at all, and may actually work against the current trend that we were seeing, especially from an tech perspective or AI perspective. CapEx was booming on that front. Number 2, bond yields. I think we've sort of picked up, through the grapevine, but also watching that the Trump administration does actually care about bond yields. They tend to respond when bond yields blow out. They have been gradual in how they've been treating this, and I think to the points we made earlier, there's a level of, hesitation of wanting to price this in as something that is more long term. I think everyone is sort of taking it day by day, and bond investors are also treating this gradually. But if we saw a blowout of those bonds, those bond yields, I think that would be something that we would need to watch for in terms of a pivot of some sort. And I think maybe a controversial one would be, presidential approval ratings. I've seen perhaps 3 houses now that have created a signal of when Trump tacos, and a taco signal, and part of that taco signal features presidential approval ratings. And, he has to care about that because he's going to, they're going to elections in the second half. So perhaps if that tanks, then again, we might see a bit of a pivot. But it would just be interesting to also keep an eye on that in addition to the things that you've mentioned.
All right. Okay. Happy for us to close it there.
Yes.
For this month discussion. Hope you found that insightful, and catch us again next month.